What if I tell you that some of the things you believe about investing are actually keeping you poor? And the best part is that many people around you have told you these things, and because you believe them, you might be making decisions that are costing you lakhs or even crores over your lifetime. In this video, we will discuss 5 biggest investment myths that most people believe in. We will also show you how to avoid them and instead build real and sustainable wealth. Make sure you watch the video till the end because myth number 5 is a mistake even experienced investors make. So without further ado, let's get started with today's video. Myth number 1 is that fixed deposits are the safest investment. Many times you must have heard, अगर safe रहना है तो FD करो, as your money is locked, it's risk free and it grows over time. Well, that might sound perfect, but there is a hidden problem that nobody talks about, that is इन्फ्लेशन। एफडी का इंटरेस्ट रेट ऑन एन एवरेज रहता है 7 to 7.5%, बट इन्फ्लेशन ऑन एन एवरेज इज अबाउट 5.5%. So essentially, your money is actually growing at approximately 2% every year if we do not consider tax effect. And it gets worse when we consider impact of taxation on fixed deposits. FD interest is fully taxable. So if you are in 30% tax bracket, your 7% FD return becomes just 4.9% after tax, which is not even beating the inflation. So in reality, FDs don't make you richer. They just make you feel safer while your money quietly loses its value. Now the question is, what is a better option than FD? If you need safety, then you can consider investing in Bharat Bond ETF. It's backed by Indian government just like FD, but it's more tax efficient and gives better results. FD is not risk free. The real risk is losing your money's purchasing power. But if you are looking to build an emergency fund, which you may require at any time, then FD is a good option to park your emergency fund. Myth number 2 is that gold is a great investment. You must have heard कि gold का प्राइस हमेशा बढ़ता है, इसलिए बेस्ट इन्वेस्टमेंट है. But let's break it down logically. Gold doesn't generate any cash flows. It doesn't earn interest. It doesn't pay you dividends. It doesn't build businesses. So the question is, how does it actually grows in value? The reality is that gold on an average in India delivers approximately 8% return per annum, which barely beats the inflation rate, so it's just enough to maintain its value. Meanwhile, Nifty 50 on an average gives 12 to 14% return per year, meaning rupees 1 lakh invested in Nifty would have grown to approximately 51 lakhs in 30 years, whereas gold value over this 30-year period would be approximately 10 lakhs only if it earns 8% average return per year. Gold feels safe because it's tangible, but as an investment, it's just a shiny rock. You can keep a small portion of your portfolio invested in gold, and for the majority portion of portfolio that would help in deriving the growth in your portfolio value could be, instead of investing in gold, invest in index funds or stocks that generate value over time. Emotional value and investment value are two different things. Gold is great for weddings, not for wealth creation. Myth number 3 is that you need a lot of money to start investing. Most people think investing is only for rich people. पहले लाखों कमाओ फिर इन्वेस्ट करना स्टार्ट करो. But that's completely wrong. You don't need a lot of money to start investing. You just need time to let the compounding do its wonders. If you start investing rupees 5,000 per month at age 25 and earn around 12% return annually, you will have more than 3 crore by the time you retire around 60 years of age. And if you wait till 35 and invest double the amount, still you will have less than half that amount, which comes to around 2 crore by the time you turn 60 years of age. So the better approach is that start small but start early. The key is to be consistent. Rich people don't invest because they are rich. They are rich because they invest. Myth number 4 is that equity investing is gambling. Equity markets dangerous हैं. Only lucky people make money. If this was true, how do investors like Warren Buffett become a billionaire? The reason people think equity market is gambling is because they don't understand how it works. Gambling is random chances. That's no control over the outcome. Investing is about owning the businesses. You are not buying lottery tickets. You are buying pieces of successful companies. Data says Nifty 50 has given more than 12% annual returns for decades. If you invest rupees 1 lakh in Nifty and hold it for 20 years, historically it has never gone negative. A better way to go about it is invest in index funds like Nifty 50 or Nifty Next 50. They track the overall markets and give consistent long-term growth. And most importantly, avoid trying to time the market. Nobody can consistently predict short-term movements. Instead, stay invested for the long term. Think like an owner, not a trader. When you invest in equities, you are buying a part of the company, not just numbers on the screen. Myth number 5 is more mutual funds means more diversification. People think कि अगर एक म्यूचुअल फंड सेफ है तो 5-6 म्यूचुअल फंड्स और भी सेफ होंगे. This is a very common mistake that people make. The problem here is most mutual funds own the same stocks like Reliance, HDFC, Infosys or TCS. If you invest in 10 different mutual funds, you are not getting more diversification. Rather, you are just paying extra fees for no reason. A better approach to this is that stick to 2 to 3 good mutual funds that give you real diversification based on your risk appetite. More mutual funds doesn't mean more safety. They just mean more complexity. Now that you know these myths, which one shocked you the most? Comment down below. Most people lose money not because they make bad investments, but because they believe the wrong things about money and also try to time the market. If you like this video, kindly hit the like button and share it with someone who needs to hear this. Also subscribe to my channel for more simple and actionable content. With that said, I will see you in the next video. Thank you so much.